Good morning, ladies and gentlemen, and welcome to today's IGE webinar. Before we begin, please allow me to introduce myself. I'm Julia Kim, Managing Director of IGE. Normally, as you may know, and as you may expect, our webinars are hosted by Dr. Jeon Kwang-woo, the Chairman and CEO of IGE. However, unfortunately, he's unable to join us due to a very important emergency, so he asked me to convey his sincere and warmest regrets for his absence today. Also, he extends his best wishes for our successful webinar and his tremendous gratitude to Dr. Subbaraman for his time today. We appreciate your kind and generous understanding. So today I will be moderating this event as a special occasion for next to an hour on behalf of Dr. Jeon. Now moving to the main event, I am so honored and pleased to introduce our distinguished guest speaker, Dr. Robert Subbaraman. Dr. Subbaraman is a highly esteemed, respected expert on the global economy, especially on Asia. Good morning to Dr. Subbaraman.
Good morning, Julia.
Good to see you again. Thank you very much for joining us live from Singapore this early morning.
Thank you for inviting me back to the IGE conference.
Yeah, our pleasure. And I have strong confidence that his insights will help us better understand the key emerging issues for the Asian and Korean economies and financial markets, especially in the context of the rapidly changing global geoeconomic and financial landscape. In the circumstances of rising uncertainty over monetary policies, escalating tensions in the Middle East, and intensifying international trade conflicts between the US and China especially, today's special attention will be given to any possible outlook changes and their implications for global and Asian economies and financial markets. This topic is of great interest to all of us. Currently, Dr. Subbaraman is the head of global macro research at Nomura, a leading global investment group. Prior to joining Nomura in 2008, he spent 12 years at Lehman Brothers, where he served as chief economist for Asia. He also held senior positions at the Reserve Bank of Australia there. Without further ado, please join me in welcoming Dr. Subbaraman. He will give us his prepared presentation titled Forging a New Path for the next about 40 minutes and followed by Q&A session until around 11 a.m. as scheduled. Dr. Subbaraman, good to see you and thank you so very much for your time today. The floor is yours from now. Thank you.
Okay, great. Well, thanks very much, Julia, and welcome everyone. Yes, I'm going to try and give Nomura's latest house view, global macro outlook, and happy to take some questions towards the end. So let me begin and let me share my screen. Are you able to see the presentation?
Yes, perfect.
Okay. Okay. Hold on. Okay, good. Okay, let's get going. Julia, you can see the screen okay?
Yes.
Okay. Okay, so let me start. This is a slide showing our latest GDP growth forecasts for the major economies and then all the Asian economies. And I think there's a few points that are worth highlighting here. The first one is the biggest economy, the US economy, we think is going to continue to grow at a fairly decent pace of 0.4 to 0.5% quarter on quarter, which is around, we think, the US's potential growth rate. The other thing that I would point out is Europe, where growth, if you look in the second half of last year, was slightly negative. So there was a mild recession in the Eurozone and UK, but the data has improved. The economy is recovering, and all the survey data is suggesting that the business surveys are suggesting that the recovery is continuing into Q2. It's not a very strong recovery, it's not as strong as the US, but the Eurozone is back to a moderate expansion. Japan, on the other hand, has had quite choppy growth, negative and then positive, and then it was negative again last quarter. But we do feel that the Japanese economy is also going to be back on a recovery path this quarter and second half of the year. I would say in Asia, the region overall is expanding pretty well. I'd say the standout is India, which is growing at close to 7%, we think, on a sustainable basis. China has been weak and will probably stay weak for a little bit longer, but as I shall explain, there is some positive news on the policy side starting to emerge. And then Korea growth was very strong in the first quarter of this year, led by exports and consumption. We do think it is going to start to slow down a little bit in the second half of the year, led by a bit weaker consumption, which has been very strong. But overall, Korean growth we have holding up pretty well, and we're forecasting around 2.5% this year. Turning to inflation, the inflation picture, it has been challenging in the first quarter of this year, and probably the highlight has been the US economy, where the so-called last mile of beating inflation did turn out to be quite challenging. We saw stubbornly high inflation in the first quarter. But our view is that as we get into the year, we will see inflation starting to come off in the US, particularly core inflation. And if you look at our forecasts here, generally, I would say we have inflation gradually subsiding. And the reason why it's gradual, it was easier last year to bring inflation down because it was more the food and energy prices coming off. And that was a lot of the supply side disruptions starting to ease. But the more stickier inflation related to housing prices, relating to services prices, relating to wage growth, is still there. And we do think, though, it is going to come off gradually. This chart, I think, is an interesting one. It shows you our forecasts for policy interest rates for many of the major economies and then some of the Asian ones. If you look at the second column for the US, you can see, for instance, we're forecasting 2 rate cuts in July and December, and I'll talk more about that. But I'd say a more important point that I think that should be appreciated is that we're now coming towards the end of May, and we'll soon be in June. And you can see that as we get into June and July, and then the second half of the year, we do have a lot more central banks starting to lower interest rates. So I guess you could say we do have in our forecast the global rate cutting cycle starting to become stronger as we get into this year. Clearly, the one exception is Japan, and I'll talk about Japan, where we actually have rate hikes. But the other point I'd make, which is interesting, is we do have several central banks starting to cut rates before the Fed. You can see Canada, ECB, Swiss National Bank, China, and there's a few others that I don't have on here. Now, turning to the US, so as I said, the US economy, it is starting to slow down. But also, I think the encouraging news is the April CPI report that came out showed early signs that disinflation, falling inflation, is starting to resume in the US after having a period in the first quarter where it was kind of stuck at a more stable level. The encouraging news, I would say, for the US inflation is when we look into the details of the April CPI report, we saw signs that the shelter costs, including home equivalent rent, is starting to ease off. A lot of the private sector rent measures have been suggesting that shelter costs in the CPI would start to ease. And it didn't show up so much in January, February, March, but in April, it's starting to show up. And the leading indicators suggest that this will continue. That's very important because the shelter components make up about a third of the CPI basket. The other point I would make is if you look at the growth side of the US economy, it is starting to soften. So we are seeing the ISM manufacturing and services surveys are both below 50 now. Consumer confidence has come off. We've seen the unemployment rate rise a little bit. And we've also seen some of the housing market measures easing off a little bit. So it does seem that the tighter monetary policy is starting to have some effect. Fiscal policy is not as expansionary as it was last year. And household excess savings during the pandemic seems to be fairly exhausted. And I would say also credit standards of banks are starting to tighten somewhat for credit cards and auto loans. And so overall, the growth picture is kind of now starting to support the disinflation as well. And that's why we have 2 rate cuts in July and December. We are probably a bit earlier than the consensus in having the first cut in July. A lot of other banks have the first Fed cut in September. But by July, we will have 3 more PCE deflator reports. And that's the Fed's preferred measure. And we think all 3 are going to be fairly benign. And we think that will be enough, plus the weaker growth outlook, not a recession, but a moderate slowdown will be enough for the Fed to start lowering rates from the current 5.5%, which is quite restrictive. And as you can see, we have 4 more cuts in 2025. and we believe that the Fed will stop its balance sheet runoff by the end of this year. A lot of people don't realize this, but if you look around the world, there is quite a long list of central banks that have already started cutting rates, led by Hungary of over 500 basis points, and I think it cut rates again overnight. We do think this list is going to lengthen, as I talked about, including Canada and the Eurozone in June. Another way to look at this is this table. It shows you three important measures that we think central banks are watching. So one obvious one is core CPI inflation, and this is CPI ex food and energy, looking at the current levels. 23 April is the last time we did a report on this, so it's comparing the latest with then. The SARM rule, some of you may know, it's a good measure of when the labor market is starting to weaken. It's comparing the 3-month moving average unemployment rate, and it looks at the latest print versus the lowest in the past 12 months. And the SARM rule is if that is above 0.5, it's typically been a reasonable indicator of recession ahead. It's not always accurate, but basically the higher the number here, the more sign the labor market is starting to weaken. And then finally, a measure of just how loose or tight monetary policy is, we look at the real policy rate, which is just the nominal policy rate less core inflation. I would point a few things out here. One is when you look at the labor market, there's some economies where there's signs that it is weakening. Not dramatically, but it is clearly weakening. Sweden is at the top of the list, and as you can see, they've already lowered rates. But also, if you look at the next two, Canada and New Zealand, New Zealand has a monetary policy meeting right now, today, but their labor markets are weakening. They have not cut rates yet. And particularly Canada, I think, is interesting because inflation has come off and the real policy rate is reasonably high. This is one reason why we have Bank of Canada cutting next month, which is a bit out of consensus. I think the Reserve Bank of New Zealand could start turning more dovish soon as well. The other point I would make for emerging markets, you can see some countries like Brazil, Mexico have very high real policy rates, including Chile, South Africa as well, and Hungary. I do think once the Fed starts cutting, these central banks still have significant room to start lowering rates. Final thing I'd say is the interesting thing is Asia generally has less room, I would say, to cut rates compared to other emerging markets and many developed market economies. And I'll talk a bit more about that later. Okay, switching to China. So China, as I'm sure you all know, has had a very challenging economy. This chart shows you just how weak consumer confidence is, going all the way back to 1990, and how the unemployment rate for young people is very high, currently around 15%. The biggest problem in China, I would say, is the property market, where there is a massive amount of pre-sold homes that property developers have not been able to complete because they are very heavily indebted and do not have enough funding at the moment to complete those homes. We estimate there's some 20 million homes that have been sold to people but are not yet delivered and are behind schedule. This has led to a loss of confidence and trust in the property market. People are not willing to buy new homes because they're scared they will not be delivered. They're worried that property developers could go bankrupt. In addition to that, you have various other challenges in China. And I think this is a good way to show you. The top two tables show you cyclical and structural headwinds. I would say there has been a loss of confidence among households in China, and they're preferring to build up their savings right now than spend. In the corporate sector is very indebted, and they are paying down debt. Exports have improved, but geopolitical challenges, including tariffs, is a headwind. And then you can see the structural challenges in terms of demographics. The labor force is shrinking. There's already been a lot of investment in China. So China really relies on productivity, I think, going forward to boost growth. I would say China is, in our view, learning from Japan. And just in the last 2 weeks, we have become more positive on the policy outlook for China. We believe that Beijing is understanding the real property market challenges now, and that a real positive policy pivot is underway. And in particular, we believe that Beijing is now focused on helping the property developers complete the 20 million estimated pre-sold homes that have yet to be delivered to their customers. That to us is so important to rebuild confidence in the property sector. But in addition to that, we are seeing more forceful policy stimulus coming out. Just last Friday, the mortgage down payment ratio for first-time home buyers was cut to 15%, which is back to the record low. The mortgage rate floor was removed. The Housing Commission cut mortgage rates by 25 basis points. We also had a very large special central government bond issuance for super long bonds of 1 trillion renminbi that will be used for infrastructure. And there was a 300 billion relending package that Beijing is going to use for local governments to buy unsold homes from developers and convert it into social housing. So there's a lot happening, but to us, the biggest policy is still ahead. And that is, we think that Beijing is going to have to directly get involved in help funding property developers to complete the unsold homes. And we think that is going to cost around 3 trillion renminbi. That is still ahead. I think Beijing right now is still working out the details for that. But we think ultimately probably there will be some central bank quantitative easing to help provide the funding. And it will probably go directly to the policy development banks. And then with the local governments, they will work out how to allocate that to get the property developers to complete these homes. So this is starting to move in the right direction for China, but it will take time. It's not going to lead to a sudden revival in the property market, because it will take clearly time to build those 20 million homes and deliver them and to rebuild confidence. But my main point is things are starting to move in the right direction, And you can see markets have taken note, and the equity market has recovered. I would say in the next month or two, markets may lose some patience and there could be a correction, but we will stick to our view that ultimately Beijing is now on the right track, and it's just a matter of time before they help forcefully resolve the property market crisis. But as I said, right now the economy is weak, and you do have deflation in China, which is shown on the left-hand side chart. Interestingly, on the right-hand side chart, the real effective exchange rate is not that strong anymore. It's weakened quite a bit. It's back to its levels around 10 years ago. And that's because of the deflation in China relative to its trading partners. So that's an important point to note, that the deflation in China has led to an increase in competitiveness. The other point I would make on China, which I think is really important, is that with the property market so weak, China has relied more and more on boosting manufacturing and production and the supply side of the economy to keep growth going. And consumption is not strong because of consumer confidence being so weak and household saving. So a lot of the supply and production is being exported. And China, as a result, because it's exporting so much, and it has deflation domestically, it's exporting deflation to the rest of the world. A good example of that is if you look at the latest April data, industrial production in April grew 6.7%. Retail sales grew only 2.3%. So consumer demand is not strong, and so a lot of the production is being exported, and this is upsetting the Americans and the Europeans, who are saying that China is dumping too much electric vehicles, solar panels, batteries, but also more broadly metals, chemicals, and many other products. The US recently raised tariffs on $18 billion worth of Chinese imports. We think Europe will do the same fairly soon. And I think it does raise an interesting question, because China is exporting a lot more now to the rest of Asia. You can see Asia's trade balance with China has plummeted. It's partly because exports are picking up, but the bigger reason is because Asia is importing a lot more from China. And I show you here the examples of India and Thailand. And I do think there is the risk that if the Europeans and the Americans put up more protection barriers and tariffs on China, and China for several more quarters continues to produce more than it can consume, that it will start redirecting more of its exports to Asia. And this could be seen as China starting to export more disinflation to Asia. So this is something of a risk I would highlight. Now I want to turn to Japan. Japan is very different to the rest of the world. It's trying to generate more homegrown inflation, and I would say overall it is succeeding. These charts, if they're blue and black, they're directly from the Bank of Japan Outlook report. And you can see that on the left-hand chart, wage growth has picked up in the latest trade union employer wage negotiations. The average wage deal was 5.2%. And this is going to help contribute to a wage price virtuous cycle that the BOJ believes is starting to develop. You know, an important reason why wage growth is finally starting to pick up in Japan is because there is now a shortage of workers, particularly as you can see on the right-hand chart, for small companies are reporting a shortage of workers. And this is a serious problem in Japan, that Japan is genuinely running out of labor. This chart shows you the working age population, so people between 15 and 65 years old. And you can see that it's steadily been coming down. And the red line is employment, the number of people working. Now, it's impossible for the red line to go above the gray line. So it's really showing you how Japan is really getting close to full labor force participation, and that if companies need to retain their workers or try to attract more workers, they're going to have to do it more and more from other companies, and that means increasing wages. This is the BOJ's own forecasts for growth and inflation. And you can see that for core inflation, they do have it coming down in FY25. That is partly due to food costs coming off. But the more important point I would make is the core inflation, which is more homegrown inflation, they see it being more stable at around 2%, which is their target. So it's getting to a level that they are starting to get more confident about. But I'd say the main point for the Bank of Japan is they are willing to be patient, in our view, because they can't afford to be wrong. The last thing the Bank of Japan wants to do is to raise interest rates too quickly and the economy to slow down and return to deflation. They want to be absolutely sure that sustainable wage price cycle is underway. And it's because of that that we stick to the view that the Bank of Japan next rate hike to 25 basis points won't happen until October, which is probably later than many other economists are thinking. But we think the Bank of Japan wants to be very confident that they have the wage price cycle firmly intact. And why October? It's because it's going to take a bit longer for small companies to pass on the wage increases, and it'll only be by October that the BOJ will be clearly sure in the data to see that wage growth for small companies has picked up. We are saying there's a 30% risk that it could happen earlier in July meeting. And the other thing that could happen as soon as June is the Bank of Japan could start to scale back its JGB bond purchases, which currently are around 6 trillion yen per month. Now, the risk, I would say, for the Bank of Japan and Nomura's own forecast is that inflation picks up faster. And this is work done by the Bank of Japan itself. And they've found that for exchange rate and wages, as the exchange rate depreciates and wages grow faster, there is a threshold where the pass-through onto CPI inflation starts to accelerate. And the BOJ's own modeling suggests that that pass-through for the dollar yen is a 15% depreciation year on year. And for wage growth is around 3% year on year. And we think that right now the exchange rate is depreciated by about 15%. And we think in the coming months, wage growth economy-wide will pick up to around 3%. So there is the risk that you're going to start to see faster feed-through and pass-through from wages and the exchange rate onto inflation. And we'll be watching that carefully. The other point I would make is that monetary policy in Japan is still extremely loose. Again, this is the Bank of Japan's estimate of the 1-year nominal rate and the real rate. And you can see they see the real 1-year rate at around -1.5%. On the right-hand chart, many estimates of R star, or the neutral rate for Japan, a big range from 0.5 to -1%. But even if you take the extreme of -1%, it's suggesting that Bank of Japan monetary policy right now is fairly loose, and very loose if you believe it's more like the middle here of around -0.5%. So there are reasons why I think the risk is inflation could surprise on the upside, core inflation, and the BOJ may need to start raising rates multiple times this year instead of our forecast currently of just October. Finally, on Japan, I would say that structurally some very positive things are developing. The running out of labor means that there is a huge labor force participation by women now. We're seeing companies investing more as they try to replace more expensive labor with robots and automation. And we're seeing a more efficient use of the capital stock. And as I'm sure many of you in Korea know, there is a corporate governance revolution happening in Japan, where there is a lot of pressure on companies to improve their price to book multiples with share buybacks and increased dividends. And there is also reforms underway to try to get households to invest more in the equity market, including tax benefits. Okay, so overall, I'm saying we're pretty positive on Japan. I wanted to show you this fundamental scorecard, which looks at various buckets of important variables: inflation, growth, the monetary policy stance, the fiscal stance, the balance of payments. And if you look at the far right, it's a weighted aggregate Z-score for all these variables. And the lower the number, the stronger the fundamentals. And you can see that emerging Asia generally is in better shape, has lower Z-scores than LATAM and Eastern Europe. And so I would say that I think we are entering a very good environment, good market environment, a more favorable market environment for Asia, because we think the Fed will start cutting rates this year. We think in July and then again in December. We think China policy is starting to move in the right direction. And we think Asia's fundamentals are in better shape than other EMs. And that means that as the Fed starts to cut rates, you will start to see more focus on emerging markets. And we think disproportionate capital inflows to Asia relative to other emerging markets, because the fundamentals are generally stronger in Asia, as you can see from here, in terms of lower inflation, better growth, generally stronger fiscal finances, and the balance of payments, you can see a lot more green than red compared to LATAM and Eastern Europe. Okay, I want to finish up with some comments on India, and then I want to talk a little bit about FX and the US elections. So on India, there's elections happening right now. The results will be announced early next month. Our view is that there's a very high chance that Prime Minister Modi's BJP party is going to win an outright majority. And we think that will be very positive because it will signal policy continuity. And under Prime Minister Modi, we have had prudent fiscal and monetary policies. We've had a lot more government investment into infrastructure. And we believe that a Modi new term will see important labor market reforms. And a good example of that is right now in India, if you're a woman, you're not allowed to work overtime. And we think that reform will be changed under a new, another Modi government. Various other reforms around the labor market will make it more flexible too. I wanted to just highlight that with India's policies being on the right track and a lot more investment starting to happen in India now, this is IMF projections, but you can see that India's economy was almost $4 trillion estimated for this year. In just 3 years' time, by 2027, India is going to leapfrog Japan and Germany to become the third largest economy in the world, according to the IMF. And I just want to make the simple point that India now has the critical mass in terms of GDP, almost 4 trillion, that if it does manage to grow at around 7% growth, it becomes very important and it quickly starts to move up the global rankings to the third biggest economy in the world. And that will be very important for investors and multinational companies as India's market grows. The other point I want to make on India is I believe the conditions are now very ripe for an investment boom. You can see here the red line, India's investment to GDP is around 1/3, but I think it could go up to close to 40% in coming years, as China experienced after it joined WTO. I talked about the government is spending a lot more on public infrastructure. That is very encouraging for companies. Interest rates are likely to come down in India because inflation has come off. Corporate balance sheets are in good shape. And with all the geopolitical challenges around China, multinational companies are starting to diversify towards India. Now, the key point is, in the past, India has always run into inflation problems. There's always been boom-bust cycles. And that's because it's historically had too low investment, not enough capacity in the economy to grow fast. But if we get that investment to GDP ratio picking up, like China did, India will be able to grow 7% and sustain low inflation. And that, to me, is very, very interesting because if you look at the India rupee against the dollar, it's always depreciated. There's been only slight periods where it's appreciated. Generally, it's been on a depreciation trend. Why? The main reason is because the appreciation of the real exchange rate has all been through inflation. This is showing you the India CPI versus the CPI for US and China. look at the difference. India's CPI has always been growing faster than US or China. Now, what I'm arguing is that this red line is going to start to flatten out more like here. And if that happens, then currency appreciation in India can happen more through the nominal exchange rate rather than through inflation and the real exchange rate. So I think that's a very important point. And what I'm saying is, if India gets the investment, it will keep inflation lower. And with strong growth, that will allow rupee to appreciate against the dollar. A big change from the historical trend. Okay, I talked about the rupee. Let me finish by saying on the US dollar, we believe that the US dollar is going to be softer and will weaken through the rest of this year. That is our base case call. It's partly on our view that US inflation and growth is going to slow down, and that will allow the Fed to cut rates in July and December, and there'll be growing expectations in the market of more cuts. But also we have the Bank of Japan raising rates in October and scaling back its JGB purchases. 10-year JGB yields are already right now knocking on the door at 1% and will probably go higher. And China, I talked about the policy direction. We do think Beijing is going to provide the funding for the developers to complete the 20 million unsold homes. So all that we think will lead to a bit of a softer dollar against other currencies. The yen, dollar yen, we're forecasting 143 by the end of the year, which is a fairly significant appreciation of the yen from its current level of around 156. These are our more general forecasts, and you can see, as I said, the dollar index we do have coming off moderately through the year. And I know many of you are interested in Korea. We do have some moderate won appreciation against the dollar to 1,300 by the end of this year. Finally, just on Trump, what is the risk, of Trump returning as president in November? I've put here on the left some possible consequences of that. We could have a more isolationist America at a time when there are two wars raging in Europe. More US trade protectionism, particularly against China. He would likely be more pro-business with a more expansionary fiscal policy. Over time, he could elect FOMC members who are more dovish, including a new chairman of the Fed in 2026, who will probably crack down on immigration. And he may also focus more on fossil fuels as opposed to green technologies. I would say, one important implication of all this is that we could see in 2025, if Trump gets in, a return of inflation and a steeper yield curve in the US. And I think the starting position is important. If Trump returns as president, we are in a world where geopolitics is more fragile. Public debt is a lot higher, and companies and households have already experienced a high inflation period. And so if inflation was to pick up again, they could quickly start to pass on higher prices and demand higher wages. So I do feel a steeper yield curve is possible under a Trump 2.0. I think initially the dollar could possibly strengthen on that, but in the medium term, we could start to see the US dollar losing some of its luster as a reserve currency. And I would just finish up by saying that it's interesting that the month before the US election in October this year, the BRICS +6 will be holding their annual summit in Moscow. And they have been, quite vocal about wanting to look for alternative to the US dollar. And it would be interesting to see whether they make any progress on that front. I'm going to stop there and happy to hand it back to Julia to see if there's any questions.
Okay, thank you very much, Dr. Subbaraman, for your brilliant and very comprehensive presentation. You covered a lot of key emerging issues these days. Considering the time constraints, we just have 10 minutes. So now I would like to open for a short Q&A session with you. First, I would like to invite His Excellency Ambassador Heo Kyung-wook as one and only special guest discussant today. He served as first Vice Minister of Economy and Finance in Korea, as well as Korea's ambassador to OECD. He also spent his earlier career at the World Bank and IMF as senior economist. Ambassador, please, you're on.
Thank you very much, Mr. Subbaraman. We very much enjoyed your very comprehensive and informative presentation covering almost everywhere: China, India, Japan, and the US. Finally, I'm on. My video is on.
Yeah, we can see you. Hi.
Let me just ask you two questions. Number one is about China. You rightly mentioned that China is finally trying to take a right step by addressing the issue of the property market. But on the other hand, you also pointed out not only there's a deflationary pressure in China's domestic market, actually they are now exporting it around the world. My question is this: China's problem, structural problem, has been its growth has been largely driven by manufacturing and the property sector. And now many people point out basically it should have now changed to the more consumption-driven model by boosting confidence and shoring up their confidence. But now actually they are accelerating investment and manufacturing, and now basically exporting deflationary pressure. Number one, whether this is sustainable in terms of trade frictions that it can incur, and second point, in terms of its imbalance in domestic market. And the third question relating to that is that still it has some positive aspects in the sense that it helps to disinflate in other economy, but how can you balance it out against the criticism that it's actually deflation can actually hurt many domestic economies around the world? That's my first question big question about China. My second question is more about Korea. And this is related to US monetary policy. You said perhaps the Fed might lower the interest rate twice, and the first comes as early as July, and I hope you're right. The question I have is here. As you pointed out, many countries are already decoupling. And now one of the big controversies in Korean domestic market is that whether Korea should lower its policy rate even earlier than the US following this decoupling, given that we have a weakening consumption sector quarterly by quarterly, and our domestic inflation is already under 3%, and we have a huge household debt. Given all these considerations, isn't it a better idea to lower domestic interest rate even before the Fed rate cut? That's my second question. Thank you.
Thank you,
Okay,
Brad.
thank you, Ambassador. They're both very good questions. So I'll try to be quick. So on China exporting deflation, because it's focused so much on the supply side of its economy and producing so much, and consumption is not strong enough. I don't think that is going to change anytime soon. The measures to fix the property market is again more on the investment side. I think to me it's partly to do with the structure of China's economy, which is more driven by state-owned enterprises. And with geopolitics, there's more pressure to have control over the economy by China's leadership. And so they're relying more on state-owned enterprises. I think the challenges are going to be with probably more tariffs from the US and Europe on China, that either China is going to have to slow down production, which will mean lower growth, or if not, they continue the high production and export it to Asia, which will mean more deflation in Asia, or they will be forced to, if Asia raises tariffs, or maybe they just don't export as much, they will have more deflation at home. I think until that they get more deflation at home or more protectionism against them, we will not see a change in this supply-driven policy. Ultimately, China needs to redistribute income from profits from companies more to workers. That is how they will get wage growth stronger and consumption stronger, and also improve the social safety net to reduce household saving. On your second question on Korea, should it decouple from the Fed? It's a tricky question. I would say that a central bank should ultimately focus on its domestic economic conditions, and so what's happening to its own domestic economy and growth and inflation. Right now, the domestic side of Korea's economy is quite resilient, is quite strong. Consumption is quite strong right now. Inflation is coming off moderately. I think right now, Korea can be comfortable to wait a bit longer. The challenge of decoupling from the Fed. So I think if the Fed is starting to lean more dovish and it's looking more and more likely that the next move is going to be a cut, then I think it is easier for other central banks to decouple and cut rates before the Fed. And that is essentially what we think will happen in the coming months for many central banks. But I think in the first quarter, there was a risk that the next move by the Fed could be a hike when inflation was starting to look high again. And in that environment, I think central banks were a lot more cautious, because if it was going to turn out that the central bank was going to Fed was going to have to hike rates further, if you were to cut rates, then in that environment, the currency could weaken quite sharply. So I think for decoupling, a precursor is the Fed needs to start to turn more dovish. I think it's just starting to maybe move in that direction. We need more months of data for that. And then on Korea's side, we need to see inflation starting moving more towards 2%, and growth maybe starting to ease a little bit. And then we could see Bank of Korea cutting. We don't think Bank of Korea will cut until October. And that's because we think it won't be showing up in the domestic data enough until then. But I would say the risk around our view is it could be earlier.
Thank you.
Ambassador, do you have any questions further, or is it enough?
No, I think it's good, but I just want to point out that domestic consumption in the first quarter
Mm.
actually is a number not only for the domestic consumption, but also Korean consumption overseas. So when you extract that factor, actually domestic consumption is not that strong at all because the growth in the first quarter is basically driven by export and domestic consumption, excluding those overseas consumption. When you look at the GNI side, it actually is not strong. So there's, I guess, more voices increasingly asking for earlier cuts, just as
Yeah,
information.
that's I think that's fair. Services consumption and tourism was important for driving it. I think we'll need to see more evidence in the data of consumption easing, and we think we will see that, but it will take a bit more time.
Okay, thank you.
Tomorrow we have BOK MPC meetings, so we'll see.
Yeah.
Thank you, Ambassador.
Thank you.
Rob, it's already passing the 11. Do you have a minute? And please let me raise one more question before you can. Yeah.
Well, I'm happy to take a few more questions.
Thank you. Actually, you know, your presentation was quite impressive, and you highlighted about the Asia. You know, it's quite your presentation and your insights are quite positive for the Asia, and you know, comparing even last year's your anticipation. As far as I remember, the title of your anticipation, the report, it was a time to shine for Asia, right? And today, you know, these days, as you mentioned earlier, the data shows you are right, and at the time, right? And in that, you know, in that sense, and do you think it's the right time for us to shift our investment from US to Asia? What do you think? What's your, you know, anticipations?
So I will preface this in that I'm not a investment specialist, I'm an economist.
Mhm.
But I do feel that Asia has been underinvested ever since the pandemic. If you look at capital inflows and foreign ownership in bond and equity markets in the region. And I think the environment is starting to look more favorable for Asia if we are in a rate cutting cycle, including the US, a softer dollar, and signs that China is moving in the right policy direction. And then I would say the other big economies in Asia, Japan, India, starting to move positively as well. It creates a pretty ripe environment for investment. So moving investments from the US to Asia, possibly. I mean, the US, as I said, is also looking quite positive and is at the cusp and cutting edge of AI. So the US, I think, is looking good as well. But I think, I guess my point is Asia has been neglected for quite some time. And I think the conditions are starting to look more ripe for investors globally to look at the region and reallocate, whether it comes from Asia or whether it's, US, or whether it's just new money, or whether it comes from Europe or other emerging markets. I'm not sure exactly, but I do think Asia is going to attract more capital inflows in the next 12 months.
Okay, thank you for your answer. And especially, you know, regarding India, you suggested very interesting views on the rupee, right? So when do you, not exactly, but when do you expect we can see the, you know, the change of the direction, I mean, appreciation of rupee?
To be honest, I think it could be very soon.
Really?
Results will be known in early next month.
Only
That's
next month? Oh,
Yes.
and do you think the investors and, I mean, the, corporates and, investors are prepared to strengthening rupee and how about the election impact its impact on the, rupee or Indian economy? What do you think?
That's right. Yeah, so the election's very important. As I said in my presentation, our view is that Prime Minister Modi's party will win a majority. That would be very important for that to happen, for our forecast to be right, because that will lead to policy continuity, which is very good for India. In terms of the market, I don't think there is a strong view right now of a trend appreciation in the Indian rupee, simply because it's never happened before. The trend has always been depreciation.
Yes.
And so if I am right that India is entering a new era of high growth, but also low inflation, that is going to be critical for my view that the Indian rupee can appreciate against the dollar over a multi-year period.
Okay, thank you. And one last question regarding the political situations especially in Asia. You mentioned India, but we already have the new PM, the Taiwan and Singapore. So do you see any implications for the economy under the new PM? And especially, considering the US, China, the trade conflicts.
Yeah, it's a difficult question to answer. So clearly, geopolitics is more fragile everywhere, including Asia. And when you have new leadership, it can lead to a change in policy direction. So we will need to watch carefully. I really hope that relations between the major superpowers can be kept on a fairly stable footing, and we do not start to escalate the tensions, because I think what we have learnt in the past several years is that politics and geopolitics is very, very important for economies and markets. We tend to focus on the Korean industrial production and GDP and CPI, but the bigger picture of geopolitics and economic trading partners and foreign policy relations is extremely important. And so we all need to watch this space very carefully. It is fragile. I think that is the case. And I'm hoping the new leadership in countries like Singapore, Taiwan, India will be able to coordinate and collaborate well.
Okay, thank you so much for your excellent response. And we have a US election in so I hope you could travel to Seoul and discuss about the result, or after the election. It'll be very special meeting.
Okay, thank you, Julia. I always love visiting Seoul, so I will definitely try to do that.
Okay, now it's time to close. So thank you, Dr. Subbaraman, for sharing your great insights with us today. I would like to also thank you, all viewers, joining our IGE webinar today. Hope to see you in person, really, next time. So today, bye now. Thank you very much. Have a great one today.
Thank you. Thanks
Thank
very much,
you.
Julia.